Welcome to Abidi Stock Market Learning. The beginning is most important. In this video, we are going to discuss the limitations of candlestick patterns. Most traders understand that no system can provide the complete accuracy. All signal fail some of the time, and some may even provide the opposite indicator based on what follows. Traders using the multiple disciplines may expect to improve their reading of the chart. As a result, an improved level of timing. This means that the accuracy of entry and exit will also improve, but no one will pinpoint the perfect entry and exit all the time. If a trader is able to increase the percentage of well-timed decisions, then overall improvement in decision experience results. Eastern indicators are revealing and often pinpoint reversal or continuation. However, they are most effective when confirming by other indicators, notably the Western one. The use of any technical system rely on an understanding of how technical analysis works, either apart from the fundamental or as a part of the coordinated strategical approach. A pure chartic track the pattern of the price movement momentum among the buyers and sellers. The belief in this approach is that the price movement is very predictable. Pitfalls are going to apply in all the analytical system, especially in the short-term chores of the market. Price movement has a random character in the moment, so the challenges of the technical analysis is to be identified signals that are meaningful, and then seek confirmation what those signals predict. There are few limitations that traders need to watch for in any technical system. Move on to limitation number 1, charting psychology, or sometimes we call it as a charting philosophy. A practical point of view about all the forms of charting is that the price patterns are reflecting of change. Fundamentals have an immediate impact on price, and that is going to show up in how price moves on the chart. Principal patterns do not cause the reversals or the continuation pattern. They are the symptoms of the broader effect that is caused by the market width or the company specific event, some obvious and other restraints. It is easy to fall into the pitfall of viewing the indicators, both Eastern and Western, in cause of effect manner. This is a mistake. Price pattern occurs in reaction to other matter as well. Move on to limitation number 2, scaling and possible misleading conclusions. Charts are constructed to scale the price movement based on the size of a chart itself. So, if a selected time period involves a price movement of 40 points, the scale of a chart is adjusted to the center the price activity during that period. The chart of a different company might involve a price movement of only 3 points. Scaling will again the central price activity, but the result may be misleading. Move on to limitation number 3, blending that make distort rather than enlighten. One technique in candlestick analysis is called blending. In this technique, the candlestick from 2 or more periods are blended and recalculated to the present different view of the price trend. So, the 3 session changes that provides no insight may be blended into a single candlestick that provides a strong indication. Properly applied, blending is nothing other than a changes in the period analysis. Just as a trader may study chart on the basis of an hour or 20 minutes rather than the full day, the definition of a session can be expanded to cover the several studies. Blending is an effective technique if used cautiously and only in the circumstances justifying it. However, it is crucial to observe that the period to period comparison is going to be distorted if the blended candlestick is compared to previous signal sessions. When the sessions are dissimilar, the outcome has to be viewed with the distortions in mind. It is also possible to blend any set of candlestick outcome in a way that distorted the true meaning of the indicators so that the insight expected is hidden. Move on to limitation number 4, forcing indicators. The quest for good and reliable information is a constant struggle for the chartist. Knowing how to interpret a signal is never easy, and one pitfall is take to seek information where none exists. During the sideways price movement, for example, it is quite possible that no important information is going to develop. Traders have to wait out the indecision between the buyers and seller before a new trend developed. Any indicators must be confirmed before acting on apparent signals. Move on to limitation number 5. A candlestick can look different on every time frame. A candlestick pattern might seem perfectly formed on one time frame, but it can also appear completely opposite on another. This makes it difficult to trust the message of candlestick pattern 100%. If you use the multiple time frame, therefore it can cause doubt for the trader to decide and execute the trades. If the candlestick of sufficient size, it might appear on the multiple time frame, but this is an uncommon occurrence. Move on the limitation number 6, unpredictability and difficult in managing risk. Trading with candlestick chart can cause an impact on the risk management. Most forex traders enter on the close of a candle and place their stop loss at the candlestick low. The problem arises from the fact that you won't know where the candle will close. It makes pre-planning a trick trade and impacted the trader's risk management. Move on to limitation number 7, lagging indicators. Technical analysis candlestick pattern is a lagging indicator because most of the forex traders wait until the close of the candle before entering a trade. This has many drawbacks, with the most important being the lagging indicators only record the results. So it leaves rooms for the trader to decide or speculate on the next price move. When price rises strongly, the emotions of greed cause and majority of the people to jump into the long position. These often take place right as the price peak. When price fall, a majority tend to panic and sell to avoid the further losses, and this is mostly likely to happen at the price bottom. So, instead of applying the buying low and the sell high approach, the outcome of the broadening pitfall is to buy high and the sell low. A market proverb summarizes this approach well. Bulls and bears can make money, but pigs and chickens get slaughtered. That's it for the video. You should take your time to understand all the concepts discussed in this video. Take your notes and go back from time to time to review the strategy which has been shared with you. Please subscribe to our channel and click on the bell icon to get the notification for our upcoming videos. Please like the video and provide your comments if any. If you feel the content of the videos are knowledgeable, then please share this video with your colleagues and friends. Thank you for watching this video once again.